All right, Mihir, Mahesh, welcome back. How are you feeling?
I'm good. How are you?
All good. How was your travel here?
It's literally 2 kilometers away.
All right. So, talking about your career, you were a credit risk analyst at Stripe,
Hmm.
and now you're a product manager at an AI company.
Hmm.
Walk me through the journey. How did you go from analyzing risk
Okay.
to building an AI product?
Okay. So it's actually pretty funny. So as I was younger, I used to think that finance is the thing that I liked, analyzing businesses, understanding what puts them in positions to actually make a lot of money, but also create a lot of impact. That's how I got into finance. Got started off early. Started off in audit first because I didn't come from a commerce background, nor did I come from a family that was in business. So I had to learn the basics. So I started off in audit because that's the only opportunity you get in college. Once that was done, I did that for about a year and a half. Got lucky, got an opportunity at ULU very early on, and started to realize that more than businesses, I started obsessing over products.
Okay.
I started understanding what creates impact and how to scale. I got obsessed with the whole concept of scaling. And then I realized that finance is just a language of understanding scale.
Hmm.
In a way, it's it's the language of business,
It
but
is,
I
yeah.
understood that scale is what makes it measurable.
Hmm.
So, but that hadn't clicked yet. So I got a couple of opportunities out of college, where got into credit risk and equity research. So I just took wherever the boat took me and went, and it worked out in the end. And then towards the end at Stripe, I realized what potential. I think GPT 3.5 had just come out towards, I think, the middle stint of Stripe, and I started experimenting with automating a few credit underwriting workflows, and I saw the potential in it. As ChatGPT 4.0, deep research, all of these things came out. Gemini came out with their models. I started to realize that this space can actually work. Started experimenting with agents like N8N, Manus, and actually automated a lot of workflows. Um, Used it for myself before I could actually pitch it even to the company. And then I realized that this is something that has a lot of potential.
A lot of potential.
Yeah, and that's how I got into AI services and products, basically. So this is my journey right now. Right now, I'm helping a company called Next Alpha AI. So they are trying to build an AI product for broker platforms.
For broker platforms.
Broker
Okay,
platforms.
so what kind of AI product?
So there's the general LLM chatbot,
Hmm.
but we're also trying to get like granular information. Now, when you open your broker account, let's say a Kite or Motilal Oswal or Angel Broking Upstock, whatever broking account you're using, a lot of the time you land on your portfolio page and you go to the company overview page. There's not a lot of information. It's very brief. It's your profit and loss. You have your revenue, EBIT, profit. Balance sheet, you have total assets, total liability. Doesn't give you a lot of information.
Yeah.
Because one is the real estate in mobile phones is very meek. It's not big enough for you to fit in a lot of context. But with AI products, for the first time, you can actually start summarizing things and keep it in tiles. So we're creating a separate section in your broker platform where you can actually go ahead and see quick results. So now let's say I want to understand what was the last earning call transcript about. Now we all know that oil prices are going to affect a lot of industries over here, right? And all earning call transcripts are addressing this problem. Now, if you want to know what is exactly happening, what is the risk, what is the mitigation of that you would have to go through at least 50, 60 earning calls in that industry to understand what's the context. What we do is you get an earning call transcript summary over there for that company. And if you want to dive deeper into it, you can always open the chatbot, basically your LLM screen, and you can have a conversation about it. A lot of times, this unstructured data is not available. You need to read through it. Now we have the opportunity to summarize it, so you can save a lot of time. The other thing is why we're building it in such a way, like, it's a very valid question, right? What do we provide that ChatGPT doesn't? So ChatGPT also does a web search, and it can hallucinate quite a bit. But because we're keeping it very focused, you're becoming a vertical AI SaaS product. So you can actually hallucinate less. You can give reliable answers, which is what brokers want. They don't want to give out information that is shaky
Of course,
to the
because
investor.
if they give out shaky information, then that's a loss for their customer. And if it's a loss for their
Yeah,
customer, it's a loss for their business.
exactly. So we're making the whole research process easier for the retail investor first, because if a retail investor is able to analyze a company and is able to make an investment, the broker makes money. The whole value chain over here, or the
Yeah.
value chain is that the value prop is that we'll streamline your research process for your retail investor so that he comes out, buys and sells faster, and he buys more volume, right? So then they make a brokerage out of it.
Yeah.
So that's the whole
Journey.
journey of the customer and what we're trying to add there.
That's beautiful. So earlier you mentioned a lot of things, and it was like a boat journey for you.
Yeah.
And talking about your journey, where you were an equity research analyst, for the people who don't know what it means,
Yeah.
or let's say if it's a word that I'm hearing for the first time, what would that mean?
So an equity research analyst basically he analyzes companies that are listed on the market, but that's not the end of it. You have to understand what the business does. You need to understand how does the business make money. You need to understand what kind of risk is it prone to. Then you start building a story around it, and then you value the company. Once you value the company, you get a certain price, and you try to understand whether it is undervalued, overvalued, fairly valued. If you think that it's undervalued or fairly valued, you buy. If it's overvalued, you wait.
But how do you value it?
So there are 2-3 ways that you can value it. One is relative valuation. So let's say you are investing in a company uh, in a certain sector. Most of these sectors trade at a certain multiple.
Yeah.
So you're trying to understand whether why, if they're trading at a higher multiple, why are they trading at a higher multiple?
Okay, so first, what you're supposed to do is look at the
Industry.
sector's multiple ratio.
So I would first start off with understanding the industry. So let's say I want to understand. I'll take an example that everybody understands because it's pretty easy. There's only two players in that market, right? So let's say food delivery space, food delivery, dining events. So if you think about it broadly, Swiggy and Zomato do the same things.
Yeah.
Right. So for me, when I'm gonna understand that industry, I'll start off with food delivery, quick commerce, dining out, and events. These are the four main segments that they have. Zomato has Hyperpure, that's a different thing. But I would look at these four industries, understand what is the market size, understand how fast is it growing, what are the underlying trends, which is why it is playing out like this. That's the first step. Then I'd dive deeper into these two companies, right? And I'd read at least 2-3 years of annual reports from both of them. If you have more than that, nothing like that. And at the minimum quarterly results that I would see is probably 8 to 10. 8 to 10 quarters is about 2.5 years of data.
Yeah.
But this is data that is very detailed. So every quarter, a company puts out an investor relations report.
Yeah.
Basically, investor presentation and a earning call transcript. Now, in the investor presentation, I would want to look at the KPIs and all of that.
Okay.
And in the earning call transcript, I am paying more attention to the management discussion, and I'm paying more attention to the Q&A round.
But wait, what's the reason you look at KPI?
So it's very important to understand the KPIs of a business. Now, if I'm looking at Zomato and Swiggy, the first KPI I need to understand is what is GMV. GMV or GOV,
okay.
right? Gross order value.
Yeah.
Right. So that is basically the amount of orders these guys have received, and there's gross order value. So how much money did they make from all these orders? Then they make a take rate out of it. Now let's say if Swiggy and Zomato's GMV or gross order value is 1,000 rupees for simple math. It's not necessary that the whole way that business works is they don't make 1,000 rupees. They make a certain percent of it to their revenue.
Of course.
So I need to understand what is the take rate, because the take rate is what defines how much money they'll make.
Definitely.
So a platform fee, all of that. Most of these e-commerce businesses work on that model. So here I understood that, okay, GMV trickles down into the revenue. So I'm understanding if their GOV is rising, if their AOV is increasing, if the number of orders is increasing. Both in quick commerce and food delivery, KPIs are pretty similar. They're not very different.
So usually each industry or each sector will have certain KPIs.
Yes,
Okay.
that's why it's very important to start with the industry.
Okay. So when you're starting with the industries, when you can also figure out what the KPIs are.
Exactly.
And what do you do for your research? Let's say you're researching an industry like the food industry.
Hmm.
How did you figure out the KPI? Is it given in some report,
Uh-huh.
or is it a story that you built around the narratives?
So the thing is, you can come to an industry in a lot of different ways.
Okay.
For me, the way I get to an industry is through conversation with people, is through my own consumption patterns as well, and it's also from interesting research reports that come out. Not from a specific brokerage house or an investment house, but I pay attention to whatever trends are playing out right now. Now, if I want to understand the food and delivery space, I would have probably thought about it from the number of times I've ordered this month. Initially, everybody wouldn't have paid attention to Zomato early on because they didn't introspect enough, like how addictive this whole loop is. Right. So once I understand where I'm looking for, then I start off with a few research reports about the industry.
Okay.
Now there's a company called Red Seer.
Red?
Seer. Red Seer. The consulting firm.
How?
They usually do the industry research for most of your IPOs. So if you go to any DRHP, the industry overview is done by Red Seer.
DRHP usually contains everything about the industry, right?
Most of the times. So it has it has an industry research overview. Basically, it has a business overview too.
Okay.
So that's a good place to start. If you can find a DRHP that basically is in your industry, you can read that first.
You can also get DRHP from NSE and BSE, right?
Yes, it's on SEBI's
So
website.
but it's the same.
Very easily accessible. You don't even have to go to the website. If you just search for whichever company you're looking for, if you know there's a prominent company in that industry, just search for their DRHP. Doesn't matter if it's old, but at least it'll give you some context over how the industry has evolved. So you can start off with that. Once you know that this is the industry you want to go to, go through the DRHP. Go through at least, if you're understanding an industry, go through at least the top 2-3 players. And then later, what you can do is you can go through a couple of research houses putting out their industry reports. A lot of these sell side analysts put out a lot of industry reports, equity reports. They put a lot of sell side research out. Now, when you actually go through it, you'll understand a little bit more about the KPIs, how the industry works, what is pushing this industry. You want to go into very specific details over there. Now, what I would suggest people to do is, if you're good at using AI products, like I wouldn't suggest using ChatGPT right now because they are more general AI. But if you can use platforms like Gemini and Claude, the research is pretty good. If you can use deep research on Gemini,
Yeah, so
solid.
this is one question that I had to you. So a trend that I am usually seeing is that a lot of people don't usually like to read in this D&D.
Yeah,
They
yeah.
want quick information.
Yeah.
And with the help of AI, it's even quicker. So is it a possibility for someone to take these reports, take the DRHP report, take the reports from all the research houses and put it into either Claude or Gemini and ask it to give a detailed explanation? Does that also work?
That works. If you're going to do it that way, I would suggest use Notebook LLM.
Okay.
That's pretty good because it also gives you an audio podcast kind of situation for your whole research. I would suggest use Notebook, but and the thing is, the way Notebook works is, if let's say you ask a question, it directly relates it to the chunk or the citation in that conversation.
But what if you don't know what question to ask?
I think there are basic questions. You need to be inquisitive. If you're not inquisitive, this is probably not the space for you.
How?
You should know that exactly what you want to know about this industry. Do you want to know how fast it's growing? Do you want to know how does the industry work? Do you want to know? Just start having a conversation.
So usually when you're looking at industries, how do you narrow these things down? What is it that you're looking for?
So it depends, right? It depends on how I ended up on the industry. So if it is, let's say, introspective, that I feel like this is an industry that's going to do well. The first
Okay, wait, what's one industry that you're focusing on right now?
Right now, mostly the AI space.
The AI space. Okay,
yeah.
And when you started doing research about the AI space, what are the few things that you picked on?
So the thing is, I started off with reading a lot of reports from NVIDIA and AMD because I wanted to understand how does the infrastructure work.
Okay.
And then after that, I got into listening to a lot of interviews and podcasts with guys like Sam Altman, Dario, and Sundar, when they were releasing their models. That's pretty information dense because I wanted to understand where this industry is going. In this industry, it's more potential based.
It's more potential based. Yeah,
It's
of course.
it's
Yeah.
not research. Your research can only protect you so much, but you need to have this leap of faith that this potential will play out.
And for you to have that potential, you need to build a solid story around it.
Story around it. This is a complete story play because it's still very early.
Yeah.
Like we see that the way artificial intelligence is evolving, every day there's something new. You open any kind of platform, either Instagram, Facebook, there's a new model out, or there's a new company that's doing something great in this space. So it's evolving so fast. So it's very hard to keep up here, and your story will keep evolving. So you need to be deep into this industry, which is why I'm trying to be in this industry so that I can understand it better.
Okay.
A lot of research won't help here. I need to be there so that I can understand it. So that when the right time comes, I can take a decision.
Fair enough.
You don't have to take a decision right now, but you need to understand it. That's why I usually suggest people to pick industries that they already understand.
Okay.
That's a good place to start. Like if your parents owned a kirana store, the best place for you to start is understand retail.
Yeah.
If you stuck to that, you would have found DMart way back. Because the basics don't change. The scale changes. Your basics are still the same. How fast does your inventory move? How fast does your cash flow come back? So these are the things you'll have to research about the industry, right? So if I'm understanding an industry that is introspective, that I have used it quite a bit, I want to understand what is the grand scheme of this industry. So then I go back and see the underlying trends first. I want to understand what is pushing this behavior. Is this behavior sustainable? The first question I want to know is any industry that goes through an uptick, whether that is government based or your consumption based, anything, they all have an underlying trend that pushes the growth, right? If you look at defense, it is any war that plays out, it's going to push up your defense spending that year, right? So you know that there's an underlying trend there. Is it sustainable or not? If I feel like now we're seeing that a lot of Indians are buying a lot of things. Before it was very hard to sell 1,000 rupee product. Now it's become pretty easy. I think people are willing to spend 1,000 rupees if they see a certain value to it. It depends on the product, but 1,000 rupees is pretty easily buyable right now.
But does it also have to do with the fact on how they perceive the brand? As in, you can say in a way bring in premiumization into the picture.
That is kind of, so that's open to discussion. I think I don't think there is value. Obviously there's a huge sector in India which is value driven, but I think there is a huge sector in India or businesses in India that are positioning themselves as a premium brand right off the bat. If you look at Jaywalking and Chapter 2 Drip, these guys are not priced cheap. They're priced really high, and then new brands. So they're intentionally placing themselves higher they're putting themselves at the premium price point, and they're associating that brand to the premium price point. And Indians are buying it. So I don't think it's changing. The playbook is changing. How you position yourself is becoming more important.
So if you position yourself as a premium brand, there are higher chances of you doing well.
I wouldn't say that. I'd say there's a higher chance of you being able to price your product higher. You might not be able to monetize a lot of people early on or in the first 5 to 10 years, but as you start delivering value, you will get a bigger fan base. You need to become aspirational. Now, if you look at Hermes and all these guys, they are so aspirational that people outside still like save up to buy it.
I'm glad you brought up a brand like this. There's a recent brand that launched a bag, a pouch, like a polythene.
Which one?
I'm not gonna say the name.
Is it Balenciaga?
So it's a literal pouch. You know the one which we get at the Kirana stores.
They're
selling it for upwards of $2,000.
Theli?
Yeah.
Balenciaga. Yeah. That's the whole marketing gimmick, right? They put out weird shit like this and they charge a high premium for it. But see, Balenciaga has become fast fashion now.
Yeah.
That premium value that they used to have before, they don't have it anymore. People perceive the brand as whatever. But if you look at Hermes, it's still like people go out of their way to buy it, and even like watches and all of these things. And but it's taken time for them to do it. So if you want to put yourself at a premium segment, initially your product is going to cater to a very niche audience, and then you hope that this niche expands. You drive, and then what happens is human beings in general, they crave what they can't have.
Definitely, yeah.
So if someone, as soon as you switch the supply to demand change to have a decrease in supply, the demand increases, you're obviously going to be able to charge a higher premium.
I see a lot of restaurants in Bangalore also doing this, creating that artificial demand.
Yeah.
So
a lot
it's a
of
good
restaurants outside also pay people to just crowd the place up so that they can charge a higher price. And it's working well.
It is, yeah.
Is it ethical is a different question, but if it's working for them, why not?
If it's working, it's working.
It's working,
If
yeah.
it's not broken, I'm not going to fix
Yeah,
it.
don't fix it.
Yeah.
That's the whole thing.
Okay, so since we're on the conversation about businesses, and you've analyzed a lot of businesses over a long period of time, and because of your experience at Stripe as a credit risk analyst, what is one red flag that you've usually noticed in companies or in people that has helped you?
Companies, it's pretty straightforward actually. So going back to it, right? So the way I would look at a red flag is I would understand whether the industry is good.
Okay.
Is it a high growth industry or is it a high margin industry? You can't be both. You can't be a high margin industry and a high growth industry at the same time. You can start off as a high growth industry and then become a high margin industry.
Okay.
So SaaS, for example, very high growth in the early 2000s, but very loss making because the cost of development was so high.
Yeah, since you brought up SaaS, one question for you. How do you see the SaaS industry playing out? Because a lot of people think the software industry is dead.
No, I think it's evolving.
It's evolving.
Yeah. So, like I said, right, so SaaS had this purple patch where they were growing significantly, but because of the tech development cost, the margins were low. If you want to start a company like Salesforce now, is it easy?
It should be relatively easier.
But
yes.
why is it easy?
Because of AI.
Development cost
Development cost reduces a lot.
You don't need to hire a lot of engineers. You need engineers who know what they're doing.
Yeah, but you don't have to hire 100, you can just hire 10.
10,
max.
15,
Yeah.
you can do it at 50% capacity
Definitely.
at least, right? And you can build another Salesforce. There's a company that is building a Jira product which is powered by AI.
Jira product.
Yeah, Jira is basically a Kanban board.
Okay.
It's mostly for product managers and it's for a way for you to assign tasks, keep track of tasks and all of that. So they are trying to build a product like that and they're doing pretty well. The product is great. It's just a matter of time till they hit it. So right now it's going through that phase of high growth and maybe not high growth, I would say medium growth and high margin. But when we look at SaaS companies in India, it's a different story. We've not had a lot of access to technology for a couple of reasons. One is desktops and laptops are still very expensive.
Yeah.
But now it's changing slowly. I think the new Apple is priced at what, 70,000?
Yeah.
Which is not bad. I think that's pretty attainable
reasonable, yeah.
for most
performance,
businesses.
yes.
Yeah. Data has become cheaper quite a bit in the past 10 years. You can see a lot of consumption on the internet has gone up. Right? We're the biggest consumers of the internet. And the data is the cheapest in the world right now that we have. And there are a lot of markets that are underserved for streamlining operations. People in India have started understanding that operations is what sustains a business. And SaaS companies are mostly operational efficiency generators. If let's say you were getting your job done with 10 people, you can do it with 8 people. Yeah. But now with AI products coming into SaaS, instead of it being 8, it's becoming 5. So that arbitrage is becoming thinner and thinner.
Yeah.
So I think SaaS in India will do well. Maybe outside they will have a little bit of push and pull. But if you are able to show value and if you're able to show some kind of deliverable either through growth in revenue or through growth in profitability, you can sell. So I think SaaS in general is not going anywhere. It's evolving. So I think people are going to try and integrate more artificial intelligence into their products and become a vertical AI SaaS provider. It makes more sense to be that way. Like I would trust a Salesforce AI product because Salesforce is the first mover here, and a lot of customers use Salesforce for the CRM. If Salesforce comes out with AI where it autocorrects my email or it types out the email based on it, they build an agent or something like that, I would trust Salesforce more than a new player because it's already there in my system.
Definitely.
For an enterprise company, it's very hard for them to switch.
Again, it's how the company adapts to the changing environment.
Exactly. Everybody needs to adapt.
Again, my apologies for taking you off topic, but again, red flags in business and in people.
So that's
business
why
is
you
straightforward for you, as you said. What about people?
No, I think I'll complete the business side first.
Okay,
I'm not yet done. So you start off with the industry. So like I said, right,
Yeah.
you kind of understand the industry. I'm not saying you need to understand the numbers perspective of it.
Okay.
It's good to have numbers, but it's better to have trends to understand what is the underlying trend over there. Once I'm done with understanding why this industry is the way it is, then you understand what the product is. Then you understand what is the revenue model. How does this product work in this industry, and how are they able to monetize this product? And then what kind of margins do they have? Then the last thing that I check is the management. But the management is the most important part that I have to check. Because if your management is not clean, that person is most probably going to take your money and run away, right? So these are the few checks that you do. Then you also have credit models that are there, but that's too number specific. I'd say for anybody who's doing equity research and credit research, these are the major checks that we do. There's a lot of overlap between it because equity research, your feedback loop is very long term if you're investing, but if you're trading, your feedback loop is short. In credit research, you're literally putting money on the line right then and there.
Yeah.
And you have a very high time horizon. You don't know when something can go wrong. So you need to be extremely confident in lending. So lending is a very trust business.
Yeah.
And equity research is more of a potential business. If it makes money, it makes money. So with people, red flags and people, I've not really thought about it, but
Now is an opportunity for you to think.
I think I go off a lot with vibes.
Vibes.
Yeah. If I don't feel
And
like
by vibes, do you mean the inner gut or like?
yeah, inner
feeling?
gut. I think that I trust more than anything. If my gut instinct says that this person might not be the right person to work with, I will not go for it. But but the thing is, over time, I've started to realize that I need to give people the opportunity. It's fine. Either prove me wrong or prove me right. So I think that has
It's a
become
win-win
it's a
situation.
win-win
Yeah.
situation. If he proves me wrong, great. If he proves me right, I had nothing to lose. I already expected this. So it's fine. I think with red flags and people, they're basic stuff, but everybody comes with their own flaws.
Yeah.
So I don't think you can really like read into it too much.
Again, just like businesses, how businesses have to adapt to the environment, I think it's also important we also have to adapt to their needs.
Exactly.
Yeah.
If you think that someone being selfish in their career is a red flag, I don't think that's right. Okay, simple example, right? If someone in your business finds a better opportunity, he should go.
Yeah.
And you should be willing to let him go for that. Or if let's say that guy has a great idea and he wants to run it through your business, if it makes sense with your business, go for it. Or else you should tell him to move on, figure out a way to make this work. So I think if people are able to adapt like this, then it's good. Or else if you're too rigid in your ways, it's very hard. Then you become the red flag.
Yeah, then you become the red flag.
Exactly.
And okay, let's say there's a 23-year-old today who's getting a package of let's say 8 to 10 lakh, and he has zero knowledge about the financial market. What's the first thing that the person should do with their paycheck?
Your first pay. This is the first paycheck, I'm assuming.
Yeah.
Have fun. That's the first thing. Like,
Okay, what about second paycheck then?
second paycheck, I would say start once you have your fun. Understand these are the things that actually give you happiness, and start budgeting based on that. If you think that going out, spending time with your friends gives you happiness, budget it. But keep a certain percentage aside every month that you can invest. I'm not saying you have to directly invest. Invest it in mutual funds. Direct investments is great for people who love analyzing businesses, and at their deathbed, if you come and tell them that Nifty, if you're just invested in Nifty 50, you would have made 15%, but you made 14%. You shouldn't have a heart attack because of that. You should be okay with it because you enjoyed the process. So I would say if you're making 8 to 10 lakhs, what is that per month? That is after taxes is around 70,000 approx. Might be wrong, so don't quote me on that. So 70,000, yeah, 10 lakhs, 10 lakhs ही पकड़ लेते हैं, हाँ 70,000 approximately. So in 70,000, start off at 10%. You're 23. Don't put up an unachievable goal right off your bat. You should invest money in yourself, experiences, education if you want to. You want to upgrade yourself. Spend money on that.
Again, one thing regarding that. So a lot of time people think investment just means either putting it in stocks, mutual funds, and other things. How important is it for somebody to put that sort of money into, let's say, for their growth, for their learning, and to have the experiences?
They should. I think that's the first priority. In your 20s, you should do that more.
Okay.
Which is why I say start off with an achievable goal. Doesn't have to be 10%. It's not a fixed rule. Start off with 5%, 10%, increments of 5. Don't start off with 1% and tell I'm investing. Start off with in increments of 5%. 5, 10, 15, 20. I'd recommend not to go beyond 20 if you're 20 to 25. As you keep having these experiences, you'll understand what am I investing for. Anybody who's investing money, they're investing it for a reason.
Yeah.
Right? It could be as simple as don't want to work after I'm 40, which is what I hear a lot nowadays. Or if I want to do what I want to do after I turn old. People don't have that freedom. A lot of times I feel like the 20 to 25-year-olds in India haven't at least our generation, our age group, the millennial generation, they didn't have the choice of what career they want to choose. So you should keep experimenting. What do you need? You need a paycheck. If you're getting a paycheck, the risk is already
Minimized. Yeah.
very low, right? So start experimenting in things that you actually enjoy doing. So one is, I think, investing in education is subjective. If you want to study, do it. But if you don't want to, it's not a requirement.
Yeah, because in this day and age, there are a lot of materials outside of formal education that
You don't need to get a degree now. I don't see the point of it. That's why I've never really like doubled down on it. Through my degree also I worked. I feel like working will teach you way more than what a degree can teach you. So if you can invest in and don't be tied down to a certain company. Gone are the days where if you worked at a company for 10 years you were getting promoted. It doesn't work like that anymore. You should be a little selfish about things. You should understand that this is what I want to achieve in my 20s and this is what I want to do.
So number one, they should have the clarity on what they want to do in life.
Most people don't have it. You only get to that point after trying things, which is why I would say that that's why I'm telling don't take a goal of investing which is not attainable. Start off small. It doesn't matter how small it is. You just need to start.
Okay, so 70,000 a month is the budget that one has. Can you give a percentage?
Breakdown.
Yeah, breakdown or a percentage sense.
So
of how they should invest.
when I was 23, I was investing about 20% of my paycheck into mutual funds, but I was also earning a little bit more than that. So for me, it was fine. But if you're at 70,000, in my shoes, I'd probably start off with 10%.
Okay.
So that's 7,000 rupees. Then after that, I would keep about 10,000 for travel expenses or
So
anything.
10,000 would be what percentage? Like again, 10%?
थोड़ा ज़्यादा ना उससे 15.
12.5.
हाँ 15%
Okay.
almost. Keep it as 15%.
Sure.
So 25. So 10% is investment. 15% is commute, travel, all of that. Depending on whether your office provides a cab or you have to travel down there, so that would vary.
No, I thought by traveling you meant exploring the world.
Okay. हाँ ठीक है. Count that as traveling only. I'm not much of a traveler, so I don't count it as that. But yeah. So if you want to travel, I would say start saving up. Do small trips. Like there's something known as goal-based investing. Start off with that. If you whatever you like to do, start setting money aside. It doesn't have to make you a huge return. it can make you a small return and your money should be safe. So that is where I would put money in, like debt instruments like bonds, debentures, and all of that. Gives you a 6 to 8% return. If you put it in an RD, also it's fine.
If it gives 6 to 8% return, and I don't know the correct inflation rate percentage,
7.2 or something.
7.2.
Yeah.
Doesn't work out, does it?
But this is anyways for your spending.
Okay.
Your whole thing is you need to just store the wealth. Let's say I put 100 rupees. 1 year later, it shouldn't become 93 rupees.
Yeah.
If it's still worth 99, I'm taking that as a win.
Okay.
Right? 1% is fine. So if I'm able to go, so let's say I say 15% towards traveling. In a year, that's what? Around 1.2 lakhs? 1.2 lakhs in a year, you earned about 7%. So you're sitting at a good amount. And I think in 1.2 lakhs, you can travel quite a bit.
Yeah.
And in the process also, if let's say you don't want to save up for the whole year, you want to travel every month, you can do that also. But obviously you won't be able to make a huge trip. You can keep that aside for travel, and then you can have a separate thing for travel, for a big travel expense. Like you want to go outside, you want to visit another country, start off with small amounts. So I would say if you're going to be the person who has wanderlust, who wants to travel every month, keep 15% aside, and keep another 10% aside for your big travel expense. So 25% is your travel experiences. So right now you're down to 35%.
Yeah.
10% is investors, 25% is experiences. I would recommend start investing in subscriptions for AI.
Subscriptions for AI.
Yeah.
Okay.
It's a very small cost. So you can start off with a normal Google anti-gravity subscription, which is around 2,000 rupees a month. Then you have ChatGPT Plus, which is 300 rupees. And then you have Claude, which is about $20 a month. So that's about 2,000 again. So that's 5,000 rupees aside for subscriptions.
Again, 5 to 10%.
Yeah, and the reason why I'm telling 5 to 10% for this is the world we are in right now. If you don't understand this, you're already starting at the 8th ball. You don't want to be there. You need to understand how to do these things. Now, for me, the biggest part was I had a lot of ideas, but I couldn't build it. Now, every week I'm trying to build something new. Doesn't have to be big. It's a small thing. I'm just trying to build it to see, okay, I can do this now, and I'll keep getting better at it. But see the compounding play out, right?
Yeah.
Every week I'm getting better at it. I'm picking up a tougher challenge. I'm picking up a tougher product to build out using anti-gravity. Using Claude and ChatGPT, I'm doing research, I'm writing PRDs, I'm writing roadmaps, all of that. So we can probably have a more in-depth session on how I use AI to make my work easier. But yeah, so 10% of your salary invest in this. So you're down 45%.
Yeah.
I would recommend save another 10% aside just for emergency.
And how would you recommend them to save that 10%?
Keep it in your savings account. You need to be very liquid. You can put it in a liquid fund.
But they can also do it for debt instruments, right? Like bond and.
Yeah, I see. The thing is, I am more worried about settlements happen instantly nowadays. Almost in one day, you get the money. But let's say you're in a situation where you're 23 years old. You're probably going to do dumb shit. So you need to have that money with you. So that is my only thing. And I don't think you don't have to maximize your savings all the time. Just be liquid. I have 7,000 in cash if in case something goes wrong. So I think now we're at what? 10, 25, 20, 25 and 45.
55 we've reached.
55 we've reached. Okay. So 55% you've pretty much traveled. You've got your AI expenses sorted. You have an emergency amount. You're investing a small amount. The rest of the money I would recommend do whatever makes you happy. If playing cricket makes you happy, if going out and drinking makes you happy, go do it. Just do something that makes you happy. It's more important to be happy than to live a miserable life and die at 30.
Makes sense.
First of all, we don't know if we're going to live till 40.
Correct.
So do things that make you happy. If that 45% is your choice, you want to upgrade yourself, go pick up a course, go pick up books. People love reading. Some people love watching movies. Some people love collecting expensive whiskeys, wines. Some people like going out and eating at different places. I'm that kind of person. I like to eat a lot. So I spend a lot of money on food. I know I'm a fat ass over there. So do things that actually make you happy. That is one thing I would recommend. And at 23, if you're fortunate enough, you don't have a lot of house responsibilities. And but if you are staying in a rented place, I would recommend don't spend more than 20 to 30% on your rent.
Okay, not more than 20 to
20 to
30%.
30%. It's better. 23, you can live at a decent place and you can also have a roommate.
Yeah.
But I would recommend, like, a lot of people end up spending like almost like 40% of the salary on rent and they start crying about it. I don't think that's on you. That's not on anybody else.
Yeah.
So if you are able to save that 20 to 30% into rent and you have another 25% to play with. If you're a rented person, you have 25%. So 25%, do whatever you want. 25% in 70,000 is around 15.
Yeah, around, yeah. Okay, so according to you, one of the mistakes that people make is spending more than necessary on rent.
Yeah.
And are there any other financial mistakes that you see people making in the category of 20 to 30 that you keep seeing it on a daily basis, but it is what it is?
I think people buy a lot of random shit which they don't
A
really
lot of
need.
random shit.
Yeah, which they don't really need. I mean, even I'm guilty of that. I won't sit on a pedestal and talk about it. Like, I love shoes. I've spent way too much money on shoes in the past. I'd say 21 is when I started buying shoes. Till I was 24, I've spent way too much money on shoes. And in the past 2 years, I didn't buy one shoe also. Because I just realized that, why am I doing this? Okay, fine, I like sneakers. But now I have enough that for another 5 years, I don't have to think about shoes. Buy it when I need it. Okay, if it gives you happiness, fine, but don't
Don't
go
blow your
out
budget.
of your way. Budget it. If you want to buy a shoe that's worth 20,000, spread it over 3 months or 2 months or something like that, right? So one is that I think we do a lot of things for the appeal of someone else rather than what makes us happy. So I think that's one mistake everybody does in the 20 to 30s, but I'd say that kind of starts dying down at the age of 25. You kind of realize that nobody gives a shit. So I think eventually people grow out of it. The other thing that I feel like a lot of 20 to 30-year-olds make is, I'm seeing this change quite a bit, but it's still there, is I think they all want to live a very comfortable life, which is why the corporate life seems very dreamy in a way. Like, you work 9 to 5, you have your work-life
balance, yeah.
Doesn't work like that. You will be on your ass before you know it. Like, it's happening in real time. It's happening. It's just a matter of time it happens to you. So you need to be prepared. One thing is, people don't realize that as you start earning more money, try to keep your expenses as they were when you were 23 or 24. Try to keep a 2 year lag between your expenses. If you can get better at understanding what actually makes you happy and budget for that, that's great. If you feel like that 25% that is left out for your happiness, if you feel like I'm feeling way more better about investing and I want to start investing more, invest more in that. Move that 5% to here, make it 15. If you think that travel is going to make you more happier, move that 5 to 10% to travel. So start prioritizing things that actually make you happy rather than doing things for someone else. Like, a lot of people like buying clothes and all. How many clothes will you buy? After a point, it's done. So a lot of people do it, and I think now, I think women have become pretty smart with this. If they like fashion, they're putting it out, right? We both know someone who does that now. So one is that, and the other thing is, I feel like they are getting a little smarter about it. Obviously, I wouldn't want to say easier for them, but it's also like, it's true, right? Like, social media, the whole perception is your physical attribution. So yeah, I don't think I should dive deeper into that.
Anyway, since we are talking about investments and
Yeah.
this is a form of short-term investment,
Correct.
Let's talk a little bit about long-term investment. Uh, Everyone says do long-term investment, do long-term investment. But according to you, and what are the disciplines that you follow for long-term investment? You know, when let's say when the market is crashing and you open your portfolio and you only see red, you don't panic. How do you deal with that? And yeah, the discipline required to be okay with that.
See, the thing is, fortunately, whenever I've opened my portfolio, I've not seen the whole portfolio red, but I've seen a few stocks that are red. Like IEX is something that I feel like was a huge mistake on my end because I wasn't paying close enough attention to a few fundamental things that I should have paid attention to. So I think when it comes to discipline, right? I think one thing is you shouldn't open your portfolio too much. If you
Okay.
know the market's not doing well, don't open it because the human brain is such that it will try to rationalize this and try to make a decision in that moment. You don't have to make a decision.
Look for an easier way out.
Exactly.
Yeah.
In long term, you don't have to. I would say if you're seeing a lot of losses, start understanding why is that happening. Most losses, markets in the short term are driven by emotions. Okay, emotions, what happened the previous day, in that current day, it's driven by that. But in the long term, it's driven by value. So if you think your story is solid, if there's not a massive thesis shift in your story, you should be fine. You should be able to say that now the market is down. I am so confident that this story is good. This will play out. It will play out in the financials, it will play out in the industry. That this company will become a multi bagger in the next 5 years or 10 years. So I should double down on this when the market is down, right? Like every time the market goes down, I push money through because I feel like that's the right time to buy. And I think anybody who's been in the market for long enough can tell you that when the markets are down, if you have the money, put it. Don't even think because we have seen enough downturns that we know that it again comes up, whatever the situation is. The only thing is how long it takes to come.
Okay, and yeah, again, long term, what time frame should they give themselves?
It depends on your age. So if you're 20, if you're 18 to 20, 20 to 25, minimum 20 years.
Okay.
Okay, and I would say don't get into direct investments if you don't like researching companies.
Okay,
Just pick up
and
mutual funds.
but what if they want to get into direct investments? Because usually the returns are on the higher side, a little higher.
Not necessarily. See, what direct investments gives you is an opportunity to pick companies that are not on the radar.
Okay.
The whole point of an alpha is that the market, usually mutual funds pick up stocks that are on the index because that's the requirement. They have a fiduciary duty to be able to justify that return and they can't lose money. They can lose a little bit, but they can't lose money when the person wants to withdraw.
And what happens if they lose a lot of money?
I mean, investors don't come. Their whole business kind of crumples.
So there's no way for an investor to protect himself in a situation like this. Let's say a
Like
mutual
what?
fund house or something loses a lot of money, and
It's a reputation hit, right? Investment is a trust game. If a mutual fund house loses you a lot of money constantly by taking high risk bets, the investor will want to pull out his money. And it's not good for them because they are driven by their AUM. And it's a reflection on the mutual fund house manager, on the fund manager basically. So they wouldn't want to take a hit on their reputation. Even if you see the small cap funds, mid cap funds, and these are the two things, micro cap also, they are picking up the ones that are pretty prominent. So the money has been made. Whoever had to make money over there has made their money, and they're very driven by the mood and momentum of the market. But in the long term, it will still do pretty well. But the only reason you should get into direct investment is that you have so much conviction in a company that it will beat the market.
Okay.
If the market made 15%, the minimum requirement for me, which is your equity risk premium, that this stock has to make is 18%. Not a lot, 3%. If I know that 3%, I'm convinced that it will make it, I should pick it. But I'm saying don't get into the market for 3%. Get into the market if it's going to be double, 30%, 40%. It should be beating the market by that much. Only then get into direct investment. And if you like it, if you like doing it, you'll get it because you're obsessed with the process. You're okay with losing a little bit of money, but you know that the ones that will play out will do well. Pareto, anywhere you go, the 80-20 rule plays out, right? 80% of your returns comes
Yeah,
from 20% of
20%.
your portfolio, right? So I think you should be very obsessed over your thesis. If you understand the thesis is good, the story is solid, the company is solid, the management is solid, put more money when the markets are down. If the markets are up, don't.
Again, so having the trust in your own research will make you a more disciplined long-term investor.
Yes.
And earlier you spoke about IEX, where you lost about 50% of your capital.
Hmm.
And so there's this conflict everybody goes through. When do I stay in a stock long enough versus when do I pull it out? What lessons did you learn from that loss?
So one thing is I didn't realize how how strict antitrust laws in India can be. Right, IEX was a very under the radar stock. Not a lot of people knew about it, and they were a monopoly in energy exchange, right? And but it started coming into the attention of the media that IEX is one stock, monopoly stock. So it got into the radar of the government, and they built Hindustan Exchange, Energy Exchange. Overnight, that monopoly just broke,
Oh,
and the stock started crumbling. I stood there because I was like, okay, IEX is there; they're a first mover advantage, so they will do well. Okay, I might lose money in the short term, and in the long term, it will make money. I tried sticking it out for 6 months, but it just kept plummeting. So I had to come out of it because this story didn't make sense. And the quarterly results that I was reading, the management also was just biding their time, I felt. So when that came out, I was like, okay, now it's time. So usually I wait for 2 quarters if there's a huge break in the story, but that's also quite a bit, I feel. In India, one thing I've understood is there's no first mover
no
advantage.
first mover advantage.
No. There's last mover advantage, but there's no first mover advantage. So you need to be very careful about what your thesis is, and when the management says something, don't take it on their word. See how they are in interviews. See what are they responding. See, the problem in earning call transcripts are and earning calls is there's only audio and transcript. There's no video.
Yeah.
A video gives you a lot more perspective about what that management is thinking. I think that's one thing. Uh, But to the contrary, right? I have never invested in a company that is on the way up. Only company I did it was Network People Technology because they were performing really well. So they were on the way up. I don't. I have a rule that I will not invest if the company is booming. If it drops, I will buy it. But if it's going up the ladder, I'm not averaging up. I'll always average down.
So you'd rather buy when the dip is in place.
Yeah, you can't time the dip. So if you have capital, do it. If you don't have capital, it's okay. It's not going to break your world or something, right?
Okay.
So one is that. So like Paytm, right? Paytm I bought it when it fell down to like 400 rupees or something. I bought it as a swing trade, but I started seeing a little bit of potential in what the management was trying to do. They made a few good decisions, and I stuck it out for a year and a half. Now I'm still holding a little bit of Paytm, but I've moved my money out of Paytm and put it somewhere else for now.
And what's the value of Paytm right now?
I have no clue. I don't open my portfolio. If I'm not, if I had to guess, it would be at around 800, 900 rupees. You can check that. I don't know. But an estimate would be that. I don't think it would have crossed that. Last time when I checked their revenue numbers and all, I think it made sense for them to be trading at that multiple.
Okay. Now, let's say if somebody wants to learn the art of investing, fundamentals, and everything, just like you did, uh, how should they do it? Where should they do it from? And when can they do it?
The same 23-year-old?
Could be anybody.
Okay, fine. So for anybody who wants to start learning about fundamental investing, it's going to take time.
It's going to take time.
Yeah.
How much time?
Took me 4 years.
Took you 4 years.
4 years to
Okay.
get good at it.
Okay. And if they want to learn the basics and just enough to get them started and to understand the market, what would they need to do?
That you can do in a year.
Okay.
Now there's a lot of information, right? I started when I was 14.
Oh,
So I was very young when I started understanding markets. So when people are trying to learn about markets now, they have YouTube. They have a lot of resources online where even if you can't read, if you're not a very fast reader, you don't enjoy reading, you can watch videos and learn.
Any books or videos that have helped
Books, I
you
would
in
say,
your
is
journey?
for Indian markets, any book by Saurabh Mukherjee is very good.
Could you recommend a few?
One is Diamonds in the Dust.
Okay.
That's his latest. No, there's also the Leviathan. That is pretty good. I haven't read that, but I should probably read it. There is Coffee Can Investing. Coffee Can Investing was the first book I read. Um, then there was Unusual Billionaires. That's more about management. Um, Another book that I would recommend for see, the thing is, the Intelligent Investor is something everybody recommends, but I think it's outdated. The reason why Intelligent Investor is so famous is because it was written by Ben Graham. Ben Graham is who taught Warren Buffett in Columbia, so that's why it has that. I would say you should read the shareholders reports of Berkshire Hathaway.
Okay.
At least there's a book about it. That's basically, it's called Letters to Corporate America.
Letters to Corporate America.
Yeah, it's basically a letter that Buffett used to write to the shareholders of Berkshire Hathaway,
Okay.
and it's a great book. Like, you'll understand how someone who's such a good value investor understands businesses that are moated, profitable, might not be growing very fast, but his whole thing was value driven. If he found a company to be profitable, have very high cash flows, have the potential to make a lot of money, he would do that, right? So Letters to Corporate America is very good, very transferable. I think that fundamental is very transferable. You should read Ashwath Damodaran's books if you want to know anything about corporate finance and valuation. His lectures are online on YouTube. You can start off with that. MBA, undergrad, corporate finance, and valuation classes are there for free. That's a very good resource to start with. There's also the valuation school. Parth, his name is. He's very good. Like, if anybody wants to learn about how to, he's a no nonsense kind of guy.
Okay.
I think he's a Jain, so he cuts through the bullshit and he talks to you like as if it's like this kind of conversation, but it's very focused content on investing. So he's very good. His course is also pretty solid from whatever I've seen. Um, if not that, you can start off with picking up any book about understanding financial statements, just basics, and then I would say start talking to people about businesses. You don't have to be right. It's better if you're wrong. If you sit with someone, let's say you go to a kirana store and you start asking him ki, okay, ye lays kitna bikta hai, or you ask him ki, you've kept Magnum, you've kept yeah, quality walls, why do you keep Magnum even though it doesn't, like, people don't buy it so much, you'll be able to understand so many things, right?
Yeah, because the more you talk to people about businesses, the more your mind will also open
you'll
up.
understand it. You'll start understanding the language of business.
Yeah.
And you understand exactly what. Now, when I say that this wasn't moving fast, why do you still keep it? There'll be an underlying trend to that. Then I'll understand ki, okay, this is why he's keeping it. Maybe that guy is paying him more to keep it over there. So you'll start reading through a lot of bullshit, right? And you'll also see that I think there was a company in US, right? The caffeine company. I don't remember the name. So they basically, the whole differentiation was they started placing their caffeine drinks near the cashier.
Okay.
So that people would come in. Usually, when you're near the cashier, right, you have a lot of impulse buy because you're just billing. So just add this too. You'll be like. So they started pricing it at the point where it's equivalent to change.
Yeah.
So people started picking it up and putting it. You just round it up.
That's good psychology.
That's good psychology. Yeah. So you start understanding where to place yourself. If you start analyzing businesses in this way, in the end, your financial statement knowledge will play out, and in the end, that will help you investing. That's why I'm saying it's a long game.
Okay, so reading these books and going through the courses, which might take up to 1 year.
If you're very fast at if you have so much time that you can do it, fine. But if you're someone who has a job to do as well, and say 3 years.
Okay, but are these things enough for somebody to start investing on their own?
They have to do it parallelly.
Okay.
You need to practice what you're doing. If not with real money, do it with, you have these accounts where you have like artificial money, right?
Yeah.
Do it with that.
Okay, now let's imagine somebody's learned all of this. And now their goal is to earn steady returns. What's a safer investment for them? Is it mutual funds? Is it indexes, or is it stocks, or is it bonds? What is it? And if you could just give like a percentage, this thing in risk terms.
Risk terms, okay. So index funds and mutual funds pretty much follow the same thing, okay. And risk is there. Moderate to high risk in equity is there. It depends on the class of shares you're buying. Basically, large cap, mid cap, small cap. Small cap risk is very
The higher the risk, the higher the chances of returns also, right?
Not necessarily. See, the thing is, more small cap stocks, they are very driven by the market. But mid cap and large cap are not completely driven by market. They're driven by few fundamentals of each business, right? A mid cap that is inching towards becoming a large cap has a fundamentally sound business around it. So I'd say that you might not make it's not necessary. People associate risk to reward. Risk is important, but it only makes sense when the reward is high, right? It's not a causal effect. High risk doesn't mean high reward. If it plays out, it means you will get a reward. How high is it, you don't know.
Yeah.
So I don't think you should go in thinking that high risk, high reward situation. That doesn't play out very often. So you can start off with mutual funds. I think that if you're investing a small amount, start off only with mutual funds.
And mutual funds, what return would they give?
Large cap mutual fund would give you like 12 to 15%.
12 to 15.
On a good year.
Okay.
It'll basically match the market. It won't beat the market, it'll match the market. Whatever Nifty is making, it'll make that much. Nifty, I think, is compounded at what, 15% now? So they'll also be 12 to 15, around that much. So they'll also be making around that much. Mid cap, small cap, when you consider the good years, bad years, it comes up to 20-25%. But yeah, you also have to see that when they have their lows, it's really bad. When they have their highs, it's really good. It's the feature, it's not a bug. That's how they are, right? But if you're looking at asset allocation, you need to have a sizable amount. Look at mutual fund as a way to create wealth. People say you have to trade to create wealth. Not necessarily, because futures and options, you're able to buy it at a cheaper price. People think that, oh, okay, I can put the same amount, buy more shares, get high leverage and get it done. It doesn't work like that. Mutual funds, you probably will have to invest a small fixed amount every month, but over time it keeps compounding, right? Compounding is your best friend in the market. The more you stay out, the more you stick it out, the better your return. You want to maximize the return so that your timeline shrinks. But if you're able to make a good return, don't become too greedy initially. Start off with large cap. Large cap, you can start off with, I would say, 50%. Then as you get better at understanding, and split it between 30 and 20.
30 and 20.
Take a little bit of a risk. I'm not saying go to the casino and don't play blackjack. Take a little bit of risk, right? So 20% you keep as small cap, 30% you keep as mid cap, 50% you keep as large cap. Then you can start moving it around. Then what you can do is, if you want to diversify, you don't want to only stick to equity, then you can get bonds into the play. Bonds are a very good instrument.
Bonds again 6 to 8%.
Depends. Corporate bonds gives you higher, 8 to 11. Can be higher sometimes.
And how can one buy corporate bonds?
And now they have debt funds.
Okay.
So you can do that, and there's also another platform called Vint Money. There also you can buy bonds. Sovereign bonds and all of these things are a little lower, 7-8% max. They match inflation. That's it. Now I think commodities is going to become a thing now. So I think if you can invest in gold and silver, a bit of it. So if I have to broadly classify for a common man, the best way to invest your money is put 50% in equity and 30% in bonds and another 20% in commodities.
50% equity, 30% in bonds and 20% in commodities. Okay. Let's imagine the person has studied on how to invest, and now he also has an idea what percentage to invest in. uh, what are the top 3 to 5 metrics or ratios that person has to look at for him to make a better decision while choosing to invest in the company?
In the mutual fund or the company?
Company.
Company, okay. So now let's say
Company and mutual funds would be better.
cool. Okay, so let's talk about it in this. Let's say person A
Hmm.
started investing a certain amount. Let's take the 70,000 guy on. He's 23.
Yeah.
He started investing his first year. So 11 months of paycheck, because first month he enjoyed. So let's say 11 months of paycheck, he invested 77,000 per year. Good year in the market, he would have made 12 to 15%. And this portfolio would have made around 15, 16%.
This is the stock we're talking about, or mutual fund.
Mutual fund.
Okay.
This is the same guy. So he made 77,000 in his principal investment. He made about 15% on the first year. Next year again he invests 77,000. Decent year, makes 10 to 11%.
Yeah.
Okay. In the meantime, he's also learning about the markets, right? And again, third year, he's learned almost whatever he had to learn about the market. And the second year would be 84,000. Third year would be another 84,000.
Yeah.
No increment, nothing. Okay. So he's made about what? 1.6, 1.6, 2.3, 2.3. He's touching almost 3.2 lakhs without making any change. 10% he's invested, he's made 3.2 lakhs. He's learnt about the market. He's already practiced it with artificial money, and he's known that, okay, I know how to pick stocks. My mutual fund portfolio has given me a return of about 12 to 15%, but this portfolio that I made, it's given me about 20%. So I think I can pick stocks now. So when he's picked out these mutual funds, the first thing that I would check is who's the fund manager. Do some research about that. Okay. The other thing is I would understand what kind of portfolio do they have.
Okay.
What stocks are in it. Because based on the stocks that are there, that is going to drive the return that you make. Right. And think about it, right? Like, I don't know how much you follow the markets, but HDFC's chairman left.
Yeah, resigned.
He resigned. And now the top board members left. They were fired. But the reason why they were fired is they missold bonds of Credit Suisse to a few investors in Dubai, right?
Okay.
That's the news. I don't know how much of it is true and false, but even HDFC is a risky investment, correct? People used to say, oh, okay, large cap, no risk. There's a risk in everything because you're trusting a company to do it. So the fund manager makes the decision whether the company is value driven, is it fundamentally strong, is the management strong. And the thing is, a fund manager and an equity research analyst has access to these people.
Okay.
You can actually have a conversation with them, with the CFOs, with the CEOs, with the COO. If they have a sizable stake in the company or want to put up stake in the company, they can have that conversation with them. The fund manager needs to be good. He needs to be experienced. He needs to have a good enough online presence for you to be able to take a call. The other thing is, what companies are there in it. Understand the companies, understand the industries that is it, and what kind of risk are you open to. I don't think you should be thinking too much about the expense ratio if these two things are solid.
Okay.
You don't get anything for cheap if you get quality for a price, right? So that is one thing. The other thing that I would recommend is not moving this money out. Keep it there. Don't try to mess around with it. The next thing is if he made what? Let's assume that he did well as a mutual fund investor. From 2.3 lakhs, it became about 3 lakhs. He's prepared to become a direct investor now.
Yeah.
Okay. Now, in these 3 years, he's probably done some research and he picks an industry. Now, when he picks the industry, he needs to understand what are the trends, he needs to understand what are the KPIs of the industry, what is the language of this industry.
So, when you say trends, what do you mean by trends?
Every industry is driven by trends. So, what human behavior is playing out or economical behavior is playing out for this industry to grow fast. Now, if I'm thinking about it, if you're a direct investor, the best way to think about it is you're starting a business and you need to analyze it. Now, let's say I want to start a food delivery business. Simple example. I can give more complex example, but let's stick to the simple one.
Yeah, just explain it like I'm 5 years.
Yeah, I think that's better. So I know that I want to start, let's say I want to rebirth Hello Panda. It's one of the first players in food delivery, right? So when I'm going to understand this market, I'll understand ki okay, is food delivery going to be a fast growth market?
Okay, that's the trend you're looking at.
Huh.
Okay.
Is it if it's fast growth, which it is not, at what rate is it growing? Okay.
Okay.
Who are the biggest players in this market? Swiggy, Zomato. What underlying trend is there? Where are human beings, are Indians eating outside more, ordering in more?
Oh.
What's happening? Why should I go into this business? So some human element will be there to it. You're selling to human beings, so you need to understand what is the human element to it, and then try to build a story around the industry, right? Now I know that okay, people are not ordering in so much. One is because they don't have healthy options. People have become health conscious. They don't they have started understanding that it is cheaper to just go pick up the food because it is taking the delivery guy only 30-35 minutes to come. So I'll only go pick it up in 20 minutes and come if it's near my house. So that's where the trend is shifting a little bit. Before, people used to order in to try new things. Now it's changing. So if you see, that is why the whole system over here is changing. The growth has slowed down. Zomato has not had double digit growth. I think they've had very low double digit growth in food delivery. Same thing with Swiggy. Um, then the other thing that I understand is there are two big guys that I have to go up against in this market. It's not a choice, it's an obligation over here. So that is the next thing I have to understand. If these two competitors are there, what are their differentiators? How can I differentiate myself so far out that I can stand out? Right. Fine. Now I understood the industry. Now I need to figure out a way to position myself in this industry. One of the smartest companies in the whole food delivery space is Rebel Foods.
Yeah.
Right.
Rebel Foods is your Fasos
and all these guys. They benefited the most out of the infrastructure that Zomato and Swiggy built. They set up cloud kitchens. Cure fit.
And what I've heard is through one cloud kitchen, they run around 20 different brands.
Exactly. So Rebel was the biggest beneficiary of this trend. The other thing is, if you look at Cure Fit also found a very niche market of healthy people, which is basically Eat Fit. Okay. They're servicing a very important segment and they're going to be IPOing very soon. They're a part of Cult. Obviously, that's why they're doing so well. They're able to expand so much. But they did well. So now I've understood that these are the ways that I have to position myself to do well in the market. So I understood the industry now. Now I need to understand the business. What does Swiggy do? What does Zomato do? What does CureFit do? What does Rebel Foods do? What are the differentiators over there? All of these guys are in the same value chain. But what is the new proposition that they're building that will service this human trend the most? Based on my thesis for the industry, I will pick a business.
So you look at their USP.
USP, yes. Okay. The main differentiator of them. And what are the moats? Okay, moats is basically, it's a term that gets thrown around quite a bit. I think the easiest way to explain a moat is, in its most simple language, moat is basically a body of water that surrounds a castle. It makes it defensible. So what are your business's attributes that makes it defensible? Like, it shouldn't be copyable, right? Swiggy and Zomato do the same thing. Yeah. But there's a reason why one person is performing better than the other person in a certain market. So you need to be able to identify that reason. Only then you can be an active investor. So then when you understand what business is doing well in this whole value chain, think about businesses industry as a way to figure out the value chain, then which value chain fits your profile. You want high growth, high return, right? You want high growth in earnings, high growth in revenue, but not all businesses are created equally. So you need to figure out where in that value chain does this lie. And then later you invest in that. Now when you're investing in that, because you've understood the industry so much, you know exactly what KPIs to look for.
Okay.
So I'd look at GMV, I'd look at take rate, I'd look at what is their AOV, I'd look at the number of people on their platform, DAUs, MAUs, I'd look at what revenue did they make, what profitability did they make. So in platforms like Zomato, which is a food delivery platform, I would not focus too much on the KPI. I would focus more on their operating margin because it's been a while. Now they need to become profitable. In Blinkit, I want to see more about what is their KPIs, because it is too early for us to be judging them on their profitability metrics, but on the revenue metrics I can judge them. For something like a dining out, which is district, their events thing, I have to look at KPIs because it's a new business. Is it working? Is there market validation? right? Hyperpure, again, I have to look at metrics only. So based on the age of the business, the line of the business, you have to look at certain things. I start off with the income statement because it gives me a very clear picture of whether the company is worth looking into or not. Whether the company is high growth revenue, whether the company is high profitability. I get a good start from there. And then I understand, okay, if I see interest over there, that means the company has debt. Okay. And then I need to see how are they managing the cash flow. Then later I go to the cash flow statement. I try to see how much cash are they able to generate from the business. I don't look at net cash flow from not your net cash flow, but basically I look at free cash flow to the firm, right? So that's basically you take your EBIT, you minus taxes from it, you minus capex, and that's your free cash flow.
Okay.
Okay. Then if I feel like, okay, free cash flow is growing, profitability is getting there, revenue is growing, let me look at the balance sheet, health of the company. How leveraged are they? How liquid are they? These are a few things that how much are they able to sweat their assets? How fast are they able to convert their cash? These are the things that I want to see in a balance sheet. What companies have they invested in? Does it make sense? Are they making smart investments? So these are the ways I judge a company. This is how I analyze the whole business on a financial statement. But whatever I've done, whatever story I've built, I'm just validating it. That's how I look at financial statements. A validation to my story. If it doesn't validate it, I need to go back and see why it is not happening. Then there's something wrong in my story.
Okay.
If my story makes sense and there's something wrong here, then I know that there's something wrong in the business. Then I need to go back and revisit my story. So this is my validation layer. Then once I'm done validating this, I have a complete picture of what the business is, what the industry is. Then I start valuing the company. I do two types of valuations mainly, sum of the parts and DCF. Sum of the parts is you basically split the company into different businesses that they have. Like we broke Zomato down. Food delivery, going out, basically district.
Yeah.
Then you have quick commerce, Blinkit, and you have Hyperpure.
Yeah.
So I have 4 business segments. Each 4 businesses, they report their revenue, they report their EBITDA. Correct? Now I need to understand what is the profitability, basically their trading value. Okay. Usually we pick up EV to EBITDA, which is enterprise value to EBITDA. Each company's enterprise value is a multiple. A multiple of that, you convert it, you add all of that up, and you get a sum of the parts valuation. Each business, how much is it valued at? So you understand which is the most valuable business and which is the least valuable business. And then you go to the DCF. DCF is more about putting my story into numbers.
Putting your story into numbers.
Yeah, I know that the industry is growing at a specific rate. How does this affect my revenue? How does this affect my margins? How does this affect my free cash flow? And how does this affect my discount rate? Once I've understood that, I have a value for the stock. And then I run simulations. I do something known as Monte Carlo simulation. Because this is a whole probability game, I want to know what is the most plausible scenario that will play out. And then I have a decision to make. Is it undervalued? Is it overvalued? Does it make sense? Does my story make sense? Is there something wrong? Then I compare, because I run a simulation, I know exactly what the market expectation is. Whatever the price is going on right now, it is trying to discount something. Whatever is going to happen in the future, how this company will be affected in the next year. Most markets price in only 1 year. Okay. So then I understand, okay, this is what the market's expectations are. And it is going to grow at this percentage. So I know exactly what to do. You call it as a reverse DCF. We call that. Okay. Then I know that, okay, if the market is expecting this, is this possible or not? That is another proxy for me to say that, okay, this is unrealistic. That means it's overvalued. I have to wait it out. And then later I see the whole company. So this I run through the whole value chain. And wherever I find value, I put money.
Okay. Okay. So somebody who's earning 70,000, they've learned how to invest money through the various books and courses that you mentioned, and they've made a corpus through a sort of passive investment through mutual funds, and then they choose to become an active investor. And once they've learned all of that and they've learned the skills that's needed, how would you recommend them to diversify their portfolio, as in the number of stocks they should keep?
So initially, I would say start off with not again, it's very subjective. Like, I've always been a huge believer in a concentrated portfolio, but diversification is okay as well. Like, I feel you should take high conviction bets. If it plays out, it plays out. If it doesn't play out, it doesn't play out. Because you shouldn't stop investing in your mutual funds. It's your corpus. At 3.2 lakhs, whatever you made, that is just for you to start investing. And 3.2 is not a lot of money. You need to find stocks that are undervalued that you can afford in that, and then hope for that 3.2 in the next 10 years to become 30 lakhs. 10x. Sorry. Yeah, 10x only. So if you're able to do that, that's good enough. So I would start off with a concentrated portfolio, but there's no right answer to it.
Okay. And short term versus long term investing.
Long term.
Let's say I understand that, but let's say if short term period is 1 to 3 years and long term is 10 years plus, and if somebody wants to park their money somewhere for 1 to 3 years and make a decent return or a good return, where should they do that?
Yeah, that 1 to 3 years is pretty long only. I think 1 to 3 years you can do equity.
Okay, and with less than 1 year?
Less than 1 year also do swing trading. Don't go into F&O.
And swing trading, what time frame or
6 months.
holding period? Holding period should be 6 months.
6 months.
And what return should they look for?
At least 20%.
At least 20%. Okay, great. And now let's talk a little bit about credit cards. A lot of young people use a lot of different credit cards, and some seem to use it sensibly and some seem to use it recklessly. What's the difference you see between the usage, and how should one use it?
Most people think that living your life on your credit card means maximizing it. Like maxing it out. That's not the right way to do it.
Okay.
You should be below a certain utilization rate. Pick cards that actually make sense to you. So that 70,000 guy, because he likes traveling so much, I would recommend him to pick a card that's a travel card. So you'll give him points for the spends that he makes. That points he can use to enhance his travel experience.
Okay.
So pick a card that actually fits that use case.
And what are the different use cases?
So one is a cashback card, the other is a travel card, and then the other one's a dining out or normal card.
And
dining
if you could recommend one card for each of these
for
categories?
travel, Amex. I think Amex is pretty good.
But a lot of people can't afford Amex.
Then I think there's Axis Burgundy or something it's called. That is also there.
Sure.
Yeah, the Axis Burgundy is there. Then even HDFC has a couple of good cards. Yeah, ICICI has a good travel card. I don't remember the name, but they have one good travel card. Regalia HDFC, correct? That is the one. Then after that, I would suggest for the cashback card, go for anything that's a petrol card.
Okay.
Because you get points on your petrol filling, right? So I think that is a good thing to have. So Bank of Baroda has a good RuPay credit card, and then there is one more ICICI Amazon Pay card. That is pretty good.
Okay.
Yeah.
And so you worked in credit risk. What difference do you see in the usage in the older generation versus the current generation?
Older generation never had a credit card.
They never had.
Like very rare. Extremely rare. Even if they got it, that's probably in their mid 40s they got it.
Is it because they were afraid of credit
Yeah,
card?
that's the main switch. The previous generation was very credit averse. This generation is very credit accepting to a certain point where it's almost worrisome, where they leverage themselves way too much. So that's my only thing.
And what's the reason do you think today's generation has embraced it?
Become more aspirational. See, the thing is, our parents' generation also came from a point of not affluence, right? It was not aspiration and affluence. It was more of conserve. Like, how do I not lose what I have? That was their only thing on their mind, and it's hard. It's obviously hard for them. The market has changed so much. Post 2000, India has become night and day.
Yeah.
But for our previous generation, it was still, they built the building blocks so that we could run. That's how I look at it. So I think that's why this major shift has happened now.
Okay.
Yeah.
And how should someone maximize their credit card usage without falling into the debt trap?
So don't overutilize it. Keep it below 30%.
Below 30%?
Yeah, if your limit is 1 lakh, your spend needs to be around 30,000.
Is it okay if it's a little higher?
Sometimes it's okay, but don't get into that slippery slope. It's okay, pay minimum amount 1 month, it's okay. but it's better to keep it below that. So let's say you spent a little more. Let's say you wanted to buy a phone. Ideally, you should have saved up for that phone. You put it on the card and you pay it off. That's the best way to do it. But let's say you wanted to buy a phone. It's a requirement, but you don't have the money right now. Put it on the card and pay it over time. It's okay to pay interest sometimes. Don't get into an issue where you pay it and then you start living off your card, because then it becomes normal. Don't normalize it. That's my only thing.
And what's the strategy to use credit card smartly? As in, should someone pay fully every month, or should they carry it over to the next month?
No, full every month.
And what's the reason for that?
I mean, don't pay interest, right? You sometimes it's okay. I said when in a situation that you can't control, do it. But in a situation where you have control, don't do it. Like, choose not to do it. Credit cards are very useful if you keep your utilization below 30%, if you're able to pay it back on time, and if you're able to utilize it to the benefit of it.
So let's say the due date is on the 25th of some month. When would you ideally like to clear it out?
I usually pay it off 2 days before.
2 days before?
2 days before.
And does clearing it out on the 25th have any impact on your CIBIL score?
No.
Nothing like that?
Before the due date, if you pay on the due date or before the due date, you're fine.
And how does one get a higher lit on their credit card? What are the
If you
factors?
pay it on time, you don't utilize it a lot,
Okay.
then you'll get a higher limit. I wouldn't recommend become Thanos and collect a lot of cards. I've seen that happen. I don't know why. So one is that, yeah, I think that's one thing that everybody should keep in mind. Like, just keep your credit utilization rate under.
Okay.
I've made mistakes too in this, so it's fine. You learn over time.
What's the mistake that you made?
I overutilized it.
And what happened?
Then after that, I started living off my credit card.
Oh.
And then I fixed it, but I got an inflow of cash like 2-3 months later, and I was able to fix it. But you learn making mistakes. But if you can avoid making the mistake, don't make it.
Yeah, learn from other people's mistakes.
Exactly.
Yeah, makes sense. And so there are a lot of people who say you can buy assets like properties with your credit card. Is that a myth, or is it?
It depends.
It depends on what.
First of all, your credit limit should be that much. One is that. So, and the other thing is the person needs to be willing to take a card payment. I think they have a limit on that also.
Yeah.
So that's the other issue.
So realistically, in India, it's not very likely.
It's getting there.
Yeah.
It's getting there, but it's still not there yet.
Okay, great. And let's talk a little bit about credit cards usage in the business day-to-day operation. How can businesses utilize credit cards to maximize their operations or minimize their risk or anything like that?
So the whole point of credit card is you're able to hold cash for a little bit longer, so you can make it sweat for your use, and you're able to buy on credit, sell on cash.
Yeah.
For any business, that's very important. Being able to convert cash faster before you spend it is very, very important. If your working capital cycle is compressed, that's the best use case for you. You're able to convert cash really fast. So credit cards help you do that. The other thing is you're able to use debt efficiently while having a certain amount of cash reserves to expand your business, right? And you can also use it for tax benefits. You can spend money on travel and all of that. These business expenses can come up on your card. It doesn't have to affect your personal life.
Yeah.
So that is one way I think businesses should utilize credit cards.
That's great.
Yeah.
Small cases and thematic baskets. How can one identify what a good basket or a small case is versus just shimmery, shiny?
So small cases, again, it's the same principles. Understand who's running the small case.
Okay.
See what is there in the small case.
And if you could, obviously this is not an investment advice, but if somebody wants to invest and they're looking at a small case today, what are the good small cases in the market?
All-weather investing is pretty good.
All-weather investing.
Yeah, that's pretty good. For someone who's just starting out and his whole point is to create wealth and preserve wealth at the same time, pretty good start.
Okay.
There's also Basant Maheshwari small case. It hasn't been doing well recently, but his fundamentals are pretty strong.
And usually what are the returns in small cases and baskets?
Pretty good, like 12 to 15%.
12 to 15.
Yeah.
And what's the difference between this and a mutual fund?
So small cases, I'm telling an average return of small cases, but there are some small cases which give you a higher return, 18 to 20%. Small cases gives you more flexibility. Now let's say that I am someone who wants to build a small case for you. Now you want to invest money. You're like, Mihir, help me out with the portfolio. I can't build a monthly investment mutual fund for you, right? You'll have to send me that money, then I'll invest it.
Yeah.
But I can make a small case and tell you that do it in this.
Okay.
I can be like, okay, see, these are thematic small cases I've built for you. This is one small case that you have to put money into every month. When you get a huge influx of money, then put this in.
Okay.
So I would say small cases are good in a good way to track your portfolio.
Good way to track your portfolio.
Track your portfolio and spread it over a month.
Okay, so mutual funds and fixed deposits are old school. They've been there for generations. Is there something in today's market that you think can replace this or provide a better return with the same amount of safety net?
So the thing is, tried and tested is good for a reason. One is FDs and mutual funds are good. I'm not saying go to FDs. FDs are not the best investment tool right now.
Okay.
But mutual funds are good. I think mutual funds are one of the best products for the Indian market right now. Small cases, I think, is a good thing. I don't believe in crypto and all of this. Like, I think crypto is something that is a fad. I mean, yeah, it's been there for a while, but there's no underlying value to it. I remember I used to be very interested in crypto, but I was a 20-year-old left-wing person that time, liberal, right? So I used to go be like stick it to the man and all of that, right? So I think no sovereign country in the right mind is going to democratize a cryptocurrency, Ethereum, Bitcoin. They're not going to do it. They won't let the control of money go out of their hand, right? So I don't think crypto is the right way to go about it. REITs are good. Real estate investment trusts are good. It's a good alternative to start off with real estate investments with a small amount instead of going with a very big amount. And I don't want to put 50 lakhs up and then my land is in legislation for 10 years. That's a pain in the ass.
So this fund provides that safety?
Yeah, it's safe. REITs are safe.
What could you explain that a little bit?
So REITs is a mutual fund for real estate.
Okay.
So it's the ways they pool money together and they put it into a commercial space. Most of the time it's a commercial space.
Okay.
And then the rent that you get from that is a dividend. So you get a yield out of it. That's why you see dividend yields and REITs are very high. So people get very confused.
So is this a concept that's popularized already in India, or it's picking up?
No, it's not. It's not picking up so much. I think it's picking up in the private market. So Beehive is a REIT.
Oh.
The space, the co-working space. They're a REIT. So REITs are picking up slowly. Embassy is publicly listed REIT. Nexus, which is Prestige, is a publicly listed REIT. Then there's another one. I don't remember the name. It starts with M. I don't remember the name though.
Okay.
Yeah.
Okay. So imagine the 23-year-old earning 70,000 after learning how to invest, after knowing what to invest in and how to invest in, and he's built up a corpus, or he's made, let's say, a profit of 5 lakh, and that 5 lakh he wants to put it into something for the next 6 to 12 months, but he also wants it to be safe and liquid. Where can he park that money?
Put in debt instruments.
Debt instruments.
Yeah. That's the best way to go about it.
Okay.
Yeah, one is that. So simple answer. So that 3.2, he converted to 8.
Yeah.
He made a profit of 5 lakhs.
Yeah.
That's what you're saying.
Yeah.
And this is in how many years?
I don't know. Could we take 10 years?
10 years to बहुत कम है. So I'm saying like 10 years is like very long. Sorry. Like whatever.
5 years.
I think if he stuck to the principles, the fundamentals, he would have made this in 2 years.
Oh. Okay.
Very easily. Okay. So 3.2 to 8, he made 5 lakhs profit. He removed that 5. He still has this 3.2. He can rebalance his portfolio. 5, he put it into a liquid debt fund, and in those 2 years, he's still investing a certain amount of money into the mutual fund, assuming that he got a paycheck rise, he got into a better job. That 10% would be worth around 15,000 a month for the last 2 years. Let's assume that. So on this side, his mutual fund corpus is building over time. His direct investment corpus is building, and he's already made a profit. He's already sitting at a good net value of 10 to 15 lakhs.
Yeah.
What else do you want? You're 28, sitting at 10 to 15 lakhs. You're enjoying your life. What
Yeah,
else do
that's
you want?
good. Okay, and insurance.
Hmm.
Not a lot of people have an idea about what insurance to go for, and there are two major insurances: life insurance and health insurance.
Hmm.
Uh, how can one pick the right insurance and not fall into the trap of insurance not being claimed and things like that?
So claim approval is one thing that they can check, but insurance I think is a solved problem now. You have platforms like Policy Bazaar and Ditto.
Okay.
Ditto is better because Ditto is still private and they don't have to put out quarterly results and they're not under that pressure to perform well. That's when they start picking up a few predatory sale tactics. So by Policy Bazaar's reputation has gone down quite a bit. So I think if you have a consulting call with Ditto, they'll explain it very clearly to you. It's a very solved problem, I think.
Okay. So there's nothing to be worried about.
Nah, I think that the best thing you can do is just call Ditto.
So there are two options in insurance. One is term insurance and one is
Life insurance and
no, no,
health
no. One
insurance.
is your
Endowment.
investment based returns.
Endowment
Yeah,
fund.
yeah, yeah.
Endowment fund.
So which one should one go for?
Go for a term insurance.
Term insurance.
Yeah.
And what's the reason for that?
Your term insurance is in case something bad happens, right? The reason why people go with the endowment fund instead of a term insurance is because they feel like if I live past 60, this money, the premiums that I spent, it's gone to waste. Endowment at least will pay me back. But those investment returns are very menial.
Okay.
You don't make a huge return out of it. If you have the money, buy both. If you don't have the money, buy a term insurance. That's way more important.
Okay. Okay. So let's talk about industries and future bets.
Hmm.
Which industries do you personally think, based on your research, that are going to boom in the next 5 to 10 years?
So I think vertical AI SaaS companies are going to boom quite a bit. Your frontier models are going to stay, but they'll have to figure out a way to monetize it. So AI is going to be a massive space, I think. But vertical SaaS companies are going to benefit the most out of it in India. Another industry that I think can do really well is, depending on how everything plays out right now, your defense companies are going to do well. That I think is a no-brainer. Everybody has kind of realized that you need bigger guns. Everybody's realized that now. If not bigger guns, you need smart engineers who can at least build suicide drones, right? I saw a meme about jihadi standing there, okay, and he's like, I didn't know AI is going for my job too because the drones. They're damn funny. So I was like, okay. So I think defense will do well. Um, Aerospace and space exploration technology is going to do better. It hasn't seemed that way, but I think it should. Uh, in the future, I think the money is going to be there. Uh, Augmented reality is something I am very bullish about.
Okay.
I feel like our hardware, it's kind of hit a breaking point now. We're not able to do as much as we want to in it. I feel like we have to go through this hardware form factor change. Look at the Meta glasses, right? Outstanding. I think that's the best way to have a non-invasive access to artificial intelligence. So getting a Neuralink chip drilled into your brain, it's better to have a glass that gives you access to AI. So that's one thing. Another thing that I would say is I'm not very bullish about FMCG right now because I don't have a very positive worldview of how things are going to pan out in case AI plays out. I think consumption might take a hit initially. Um, Financial institutions will do well, wealth management and all. People are, I think, their priorities are coming into place now. So companies like HDFC, AMC, all of these guys are doing well, surprisingly.
Okay, so let's say you're building a new portfolio today and you have 100% with you. How would you allocate that 100% in these potentially booming industries?
See, the problem is right now in AI, there's not a lot of plays that you can bet on. So I'll have to, right now, my thing is I'm playing complete value bets. So SaaS companies, I'm picking up the ones whichever are there, whichever are solid and good. So I'm picking them up. A couple of them are tech companies like your Paytms, Meeshos, Zomatos, and all these guys. So right now I'm picking up your startups that started off 10 years ago, have gone public now, have gotten beaten up by the market, trying to understand what they're doing, how will they evolve, and I'm putting a bet on them.
You're putting a bet on them.
Yeah.
Okay.
That's pretty much how I'm doing it. Because
Okay.
right now the industries that I want to invest in, the options are very low.
Options are limited. Makes
Yeah,
sense.
so a lot of my portfolio now is moved to US stocks.
Again, so if somebody wants to invest in US stocks, how
In
would they
money.
do?
End Money is an application you can do
What's the
through that.
spelling?
IND Money.
End money. Okay.
Yeah, you can do it through that.
Okay. And what companies are you betting on?
I've betted very heavily on Meta.
Meta.
Meta is my biggest bet.
Again,
right now.
augmented reality.
Augmented reality, I like Zuckerberg. I like the business that they're in. I like ecosystem players. So Meta is a massive ecosystem.
Hmm.
So
Okay, so this is a question where I just want pointers from you.
hmm.
If somebody today with 10,000 rupees wants to get into investing, what are the steps they should take in the next 24 hours to be on the right road?
Just watch a YouTube video of how to start investing.
YouTube videos on how to start investing.
How to start investing.
Okay, and anything else?
In 24 hours, just do that.
Okay.
If you have the time, watch the Google talk that Ashwath Damodaran has put out. The two videos. One, he's wearing a white vest, and in the other one, he's wearing a red shirt. If you can watch those two videos, you'll actually be very passionate about investing. So I think if those are two things you can do in 24 hours, that's a good start.
Okay, and if somebody had 1 week?
Start reading those books.
Start
Start
reading
one
those
book.
One book.
You don't have to finish it in a week. You can start at least.
And what about 1 month?
At least finish one book.
And
then you know if it is for you or not.
Yeah, makes
Direct
sense. You need to give
investments.
it at least 3 weeks to figure out if you like it or not.
Exactly. And then it'll take you. One good thing about all these algorithms is now that it auto adjusts to your interest. So you'll start getting recommendations of those videos only.
Yeah.
I think you'll be fine.
Yeah. Well, Mihir, is there anything else that you would like to add before we close this segment?
No, nothing as such. I had a lot of fun. Maybe next time we can do a session on artificial intelligence completely.
Definitely. We'll get feedback from the listeners
Listeners.
and see what they want to learn and
Done.
explore.
Done.
Well,
Thank you.
thank you so much for
Thank you
joining
so
us.
much.
Thank you.
Thank you.